4 of the most proven hedge fund strategies. Hedge fund strategies are a collection of rules or guidelines that a hedge fund abides by in order to safeguard themselves against market fluctuations in stocks or securities and to turn a profit with minimal working capital without putting the whole budget at stake. 1. Long/short equity strategy. A trader might buy $100,000 worth of ABC Computers and short the equivalent amount of DefTech shares if ABC Computers appears to be undervalued in comparison to DefTech. In this case, there is no net market exposure. If the trader is right and ABC Computers does outperform DefTech, regardless of what happens to the market as a whole, the investor will profit. If ABC increases by 35% and DEF increases by 30%, the trader will sell ABC for $135,000, cover the short position in DEF for $130,000, and earn $5,000. However, the trader will lose money if DefTech outperforms ABC Computers due to the trader's inaccuracy. 2. Neutral market strategy. A fund manager might invest long in the 10 energy stocks that are anticipated to perform better than predicted and short in the 10 energy stocks that may well perform worse. As a result, regardless of what the actual market performs, in such a scenario, the gains and losses will equal each other out. The gain on the long stock is therefore offset by a loss on the short even if the sector advances in any direction. 3. Convertible arbitrage. Let's say ABC decides to issue a 1-year bond that has a 5% coupon rate. As a result, it has a $1,000 par value on the first trading day, and if you held it to maturity, 1 year, you would have earned $50 in interest. When the bondholder wants to convert them, the bond is convertible into 50 shares of ABC's common stock. At the time, the shares cost $30. The convertible bondholder could activate their conversion option if ABC's stock price increases to $35. Currently, they can get 50 shares of ABC's stock. $1,750 is the value of 50 shares at $35. Therefore, if the bondholder paid $1,000 for the bond in question, they now enjoy a profit of $750. 4. Global macro strategy. The 1992 shorting of the pound sterling by George Soros is a great illustration of a global macro strategy. He opened a sizable short position worth more than $10 billion worth of pounds. As a result, he benefited from the Bank of England's unwillingness to either raising interest rates to levels that are on par with those of other participants in the European exchange rate mechanism, or allowing the pound to float. On this particular trade, Soros made $1.1 billion. Not a bad result. If you have enjoyed this video, please give it a like and subscribe, and don't forget to turn on the bell for upload notifications. Thanks again. See you all next time.